I don't think China's the biggest victim here, actually. I think Korea, Japan, the bigger allies to the United States. I think at this stage, it has to be calling the White House and saying, hey, this is really big trouble for us. China has been stockpiling oil. You can't block Russia and block the Middle East at the same time. It's just economically, that would be totally suicidal.
Extreme volatility is hitting the global markets as the Iran war intensifies, with Asian markets leading the charge downward. The Korean Kospi index is down about 12% overnight, 15% on the week. The Hang Seng index is down about 7%, and the Nikkei index is down 8% on the week. Meanwhile, U.S. markets are seeing a big rebound today on the 4th of March. So the S&P 500 is up 1%. The NASDAQ is up 1.5%. Bitcoin is up 7% on the day, recovering from most of its losses earlier last week. It's now at $73,000. So what's next for global markets? What's next for U.S. markets? And why is there such a big divergence between the West and East right now? Louis-Vincent Gav is here with us to discuss what's next for global markets, commodities, and oil. He is the CEO of Gavekal. This episode is brought to you by Kalshi. It's a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here. New traders can get $10 deposited to your account when you sign up and trade $10. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Louis, welcome back to the show. Good to see you again.
Great to see you. Thanks for having me on, David.
I appreciate seeing you, and it's always good to have you back. Louis, let's just talk about what is happening in Asia first and foremost, given that you and your research team cover the entire globe, and Asia is one of your specialties. Like I mentioned in the introduction, a lot of volatility since the beginning of the week, and the headlines that I'm reading are attributing the sell-offs in Asia to the Iran situation, given that Korea and China and to a certain extent Japan are all dependent on oil imports to support the economy. So what is going on currently in the Asia markets, and maybe you can discuss whether or not that's going to have a spillover effect on the rest of the world?
Yeah, well, again, thanks for having me. No, look, I do think the whole news out of the Middle East is problematic for Asia. When you look at where the oil from the Persian Gulf goes to, whether the oil from Saudi, the oil from Kuwait, the oil from Iran, it mostly goes to Asia. It's like 90% of it goes to Asia. So the idea that the Persian Gulf could stay blocked for weeks, perhaps months, creates legitimate economic challenges for the whole region in a way that, say, it doesn't for the United States. The United States, for all intents and purposes, is energy self-sufficient. You have, the U.S. needs to import some heavy crude and produces too much sweet light crude, but by and large, the U.S. is roughly even on its energy balance. Asia isn't. Now, when you look at Asia, you have countries like China that have built big stockpiles and can probably withstand any interruption in imports for a few months. But this isn't the case of other countries. It's definitely not the case of Korea. It's not the case of Thailand. It's not the case of the Philippines. It's not the case of India. And so I think right now the markets are, confronting. It's the old story. If you're going to panic early. And in a situation where all of a sudden there is big uncertainty about the energy equation, it's a shoot first, ask question later. Having said that, you mentioned the big rollover in Korea. Korea's fallen hard, but it had also risen a lot. When you look at the curve of the Korean market, most people don't realize this, but coming into Christmas of last year, Korea was the best performing stock market in the world. It was up something like 75%, or the major market at least. It was up something like 75%. And on Christmas Eve, the Korean government changed its fiscal rules, where in a bid to reinforce the Korean won, which they felt was getting too weak, they said, look, all of you guys have made tons of money buying Microsoft, buying Amazon, buying Facebook, and whatever else. If you repatriate your money now and reinvest it at home, you won't have to pay capital gains taxes. And so all of a sudden, there was a massive fiscal wedge, an enormous fiscal incentive for people to sell the NASDAQ and buy the Kospi, for the Korean investors to sell the NASDAQ and buy the Kospi, because Korean investors had been huge buyers of NASDAQ in the big run up. So, and that's what they did. And the Korean stock market between Christmas and essentially 3 days ago went up another sort of 45, 50%. It just went up absolutely in a straight line. And so confronting a situation where all of a sudden there is more uncertainty, if you've owned Korean stocks over the past 12 months, you've made something like 120%. I think a lot of people are just saying, okay, maybe I cash in some of my gains here. So you're right. In absolute terms, the 12% drop in the Kospi or whatever it is looks like a lot. But remember, it basically brings us back to where we were 2 weeks ago.
So given that, like you said, a big chunk of Iran's oil exports, I think something like 70% of the crude transmitting through the Strait of Hormuz, which by the way, right now is closed, goes to Asia, and China being one of the largest importers of uranium crude oil. And 20% of the global crude transits through the Strait of Hormuz. What happens to China geopolitically if the Strait of Hormuz continues to be closed in the foreseeable future? Do you see China putting additional pressure on the U.S. and its allies to end the war? Does China pivot more to Russia? Does that change the calculus for what happens in Ukraine? Is there a bigger geopolitical shift now that China is essentially choked off from cheap oil?
I don't think China's the biggest victim here, actually. I think Korea, Japan, i.e., the bigger allies to the United States. I think at this stage, it has to be Japan and Korea calling the White House and saying, hey, this is really big trouble for us. And this for several reasons. First, China has been stockpiling oil, number one. Number two, as you point out, China is buying today now a lot of oil from Russia, but also a lot of oil from Kazakhstan, from the various stones and natural gas, where they have built pipelines and therefore have different conduits. I think the third thing we have to acknowledge is China really for national security reasons, not for green reasons, but for national security reasons, for the past 10 years has pushed electric cars actively on the population. And as a result, China today has a higher percentage of electric vehicles on the road than pretty much any major country. And so no doubt, like higher oil prices are not great. Higher shipping costs because the tanker rates have also, you look at the oil price and you might think, oh, well, the oil price hasn't gone up that much. But you have to think if you're China, if you're Korea, Japan, the tanker rates have also gone absolutely through the roof. So the cost of bringing that oil to you now has risen a lot. It's not just the oil price. There's also the transportation costs that have gone up a lot. China also has, I think, always the option, because they've invested so much in their grid, to really crank up electricity and try to do more with electric buses, electric cars, so on and so forth. So I'm not saying this is ideal, but if you want to look at the victims of the Straits of Hormuz closing down, China isn't the biggest one. The biggest ones are India, Thailand, Japan, Korea. Those are the guys that stand to be hurt the most. It's not ideal for China, but China has options that these other guys don't.
And what is Korea doing about this? What is Japan and Thailand doing about this? Are they going to the U.S. to ask to buy American oil?
I think they're going to do one of two things. First, you buy up whatever oil you can, hence the higher price, enhance the shipping rates going absolutely through the roof. So you go to the market and you buy the oil that you can. Now, what's interesting is so far, if you look at the oil price, the spot has moved a lot, but further out in the curve, the prices haven't moved all that much. And so it's almost as if everybody's expecting this crisis to be fairly short-lived. So there's a short-term problem because the straits are closed, and right now people are paying up for oil right now at the spot. But a year from now, 2 years from now, the market seems to be assuming that this will get resolved.
So
At least that's what's priced right now.
does Russia come out winning from this situation, given that a big percentage of its GDP is oil and natural gas exports?
Look, a higher oil price is good news for Russia. There's no doubt about it. Not only that, a situation where the Strait of Hormuz is closed means that the Western pressures to curtail Russian exports are going to abate. It's just not politically feasible to say to Russia, "Hey, you can't export," and at the same time as the Persian
But
Gulf is
Trump will then
closed.
put tariffs on those countries trading with Russian oil, correct?
We'll see. I doubt it. And Europe has already come out and said, well, some of the European countries and said, look, we're going to get more nat gas. We're going to start buying more from Russia because, the nat gas. But now that Qatar can't export, the nat gas price in Europe has gone up something like 80 or 90%. So it's you can't. I don't think you can have essentially wars going on at the same time with two of the world's biggest oil regions. You can't block Russia and block the Middle East at the same time. It's just economically that would be totally suicidal.
What happens now to the price of oil? We're currently at I think $73. Yeah, $73 a barrel on the WTI, and it's actually come down a little bit since yesterday. Where do you see this headed?
I'm surprised by the fact that the oil price hasn't moved higher. I'm surprised it hasn't moved higher. I would expect it to be higher from here. $73 hardly seems expensive, and again, what's all the more surprising is that it's really just the front end of the curve that has moved a lot, not so much the further down the curve, and so. Yeah, I mean, to be honest, if you had told me everything that we've seen in the past 4 or 5 days, again, the Persian Gulf being closed, I would have thought oil would be 90 or $100. So I think that the markets have been very, very well behaved in the face of all of this. And again, I think when you look at further out in the curve, the assumption that the market is telling you right now is that this won't last. This won't last because either Iran is going to have to come to the table, which to me seems unlikely, or because militarily the U.S. and Israel will wipe the floor with Iran, or I don't know what the market assumption is, but it seems that it's absolutely not pricing in a scenario where the Persian Gulf stays closed for weeks on end. For now, this is not being priced. And to be honest, if you look at equity markets, you're right that Korea has rolled over hard, et cetera. But again, it had gone up a lot. If you go a little bit, you look at the S&P 500, and we're down 4 or 5% from the all-time highs, and which in the whole scheme of things. It's if you just had the S&P 500 and you were looking at the chart, you wouldn't know that we're in a massive geopolitical shift here.
I'm going to get back to that. Is it a massive geopolitical shift? But going back to just finishing up on oil, so traders on Kalshi, it's a prediction market, are predicting 74% predicting $74 and above. So most people on this market are agreeing with you that oil is heading higher. What happens to the global economy, Louis, once oil hits 90 or 95 or $100?
So economic activity is energy transformed. And for us, one of our big indicators is the ability that companies have to take energy and generate profits out of it. And so the cheaper the energy, the better for growth globally. And so to answer your question, I think $90, $100 is a massive, massive break on growth. It's a massive break on growth in a number of emerging markets, countries like India, countries all across Southeast Asia, even in China. Countries where growth is highly energy intensive, really it stalls growth. So that's number one. Number two, I think if you look at most Western democracies, whether you look at your Japan, whether you look at Europe, whether you look at the United States, the big issue of the past 5 years has been the rise of inflation and how disposable income have been hit, especially amongst lower income earners. Disposable incomes have been squeezed something like crazy. And the big mantra in the US has been, the K-shaped economy, where if you own assets, you've done fine. And if all you own is your two strong arms and you're a worker, you've been getting squeezed. Now, the reality is if you get to a situation of oil at $90, I don't think asset prices are rising. So your upper end of the K-shaped is struggling, and your lower end gets massively squeezed on their income, higher utility bills, higher gasoline bills, and so then you can move, I think, into a recession decently quickly with oil at $90.
What does the Fed do in that situation?
I think it cuts rates. Now you could say, well, you're going to have higher inflation, Fed shouldn't cut rates, etc. But the reality is the Fed has shown. Everybody talks about the Fed's two mandates. The reality is the Fed has three mandates. One of them, and perhaps the most important one, is financial stability. So if you think it has financial stability, employment, and inflation as a mandate, I think the past 5 years have shown, and this is true in Japan, this is true in Europe, this is true in the United States, that for most Western democracies at this point, fighting inflation is actually the third priority between the other three mandates. So to the extent that you have struggling equity markets, to the extent that you have rising unemployment, central banks will cut rates.
The Fed is kind of trapped in that case then, right? Because on the one hand, like you're right, they have potentially three mandates to look at, but inflation is the public-facing most important one for them. At least that's what they've communicated. And if oil goes up, it's reasonable to assume inflation goes up. Yes, go ahead.
Look at what they did in 22. Inflation shot up in 22, and they kept doing QE. They were doing QE they were still doing QE when inflation rate was 6.5%. So they didn't feel trapped then. And they argued it was a one-time shock and that it was all linked to Russia's invasion of Ukraine, etc. They'll do the same this time. They'll just say, oh, yeah, sure, inflation is high, but you can disregard that because it's a one-time shock linked to energy, and we're looking beyond it, etc. Now, of course, for the end consumer ends up. So the inflation rate itself is a one-time shock. The inflation rate goes up and then it comes back down to say 2 or 3%. But the squeeze on disposable income is there, right? It's a little bit like, I weigh 95 kgs today. If I go to 105, I've gotten too fat. And then if I go from 105 to 107, my rate of appreciation is decelerated, but I'm still way too fat and I'm actually getting fatter. And that's the problem with inflation. That's what we saw in 22. You had a big surge, disposable incomes got squeezed. Prices never went back down. It's just the rate of appreciation went back down, but the squeeze has continued. And so if we get, I think, another squeeze on inflation, politically, it will be actually problematic. It'll be problematic first because, of course, President Trump ran against the idea of wars, number one. So that will be the first problem. And number two, so that'll be the first problem. And number two, inflation is a killer of political career. It's, you look at every country when inflation accelerates, people get voted out. It's the one thing that people absolutely hate.
Well, how is this going to impact the midterms, you think? On the one hand, it's looking like the U.S., it's got two consecutive victories, first in Venezuela, then in Iran, at least for now. We'll see what happens. But like you said, inflation may be a risk, which the American people don't want, right?
Yeah, we'll see. I'm not sure about the win in Iran, to be honest. We'll see.
Yeah.
I'm not sure that's a win. If you were living in Dubai or Qatar right now, it wouldn't feel like a win, I think. As you're looking to pay hundreds of thousands of dollars to get you out of what seems to be an increasingly closing trap. So I don't know. I think it's too early to sit on an aircraft carrier with a mission accomplished banner, George Bush style. So
you mentioned, yes.
So going to the midterms, here's what I think. When I look at the coalition that President Trump built. It was a very to win very handsomely at the last election. It was a very broad coalition. You had the Make America Great contingent, but you had a very strong contingent, maybe, I don't know, 10, 20% of voters that weren't as much Make America Great as America First. Guys who were very adamant on normal foreign entanglements, guys who were very adamant on we need to do more for the American workers. So that was, part of your contingent. But another part of your contingent where I would say old school, old-fashioned liberals, people like Bobby Kennedy, people like Tulsi Gabbard, who were also very much against both regulatory capture of institutions like the FDA and whatnot. They were against that, and they were also against foreign entanglements. Now, I think the big risk for the midterms for the Republican Party is that those two constituencies are just, it's not that they're going to go turn around and vote Democrat. They're just not going to turn around to show up. They're not going to vote. Now, most parties lose the midterms. If you win the presidential, you lose the midterms anyway, because the opposition party is more fired up. They're better at motivating their voters, and the guys who are in power struggle to get their voters to the poll. But today, I think roughly 25% of the people who voted for Trump last time around aren't going to show up because they're going to feel like they were lied to. They were lied to about the Iran war, and they were lied to about the whole foreign entanglement thing.
Speaking of, let's talk about this massive geopolitical shift that you mentioned earlier. Like you said, the markets aren't pricing in a massive geopolitical shift with the S&P down only a couple percentage points from its highs. It's up, like I said, today. Now, what second order effects of the war in Iran are perhaps markets not pricing in?
Look, the most important thing, of course, is the energy price, right? And again, I think for now, the energy price has remained very muted when you think of the potential disruption if this continues. I think a second order effect, to be honest, is if you look at countries like Saudi, like the UAE, like Qatar, these guys have been huge buyers of Western assets for the past couple decades. But they have massive sovereign wealth fund, things like the Abu Dhabi Investment Authority, the Abu Dhabi Investment Council, the Mudabala, like all these huge, they've been tremendous buyers because these countries were running massive surpluses, and recycling these surpluses into Western assets always made sense. Now, if this Iran war doesn't last, then fine, and we brush it off, we keep going. And in fact, if you get good regime change in Iran, and on the other side of that, Western companies can start investing in Iran oil production, etc. There is a good outcome out of all of this potentially. But if this war drags on, if the Gulf stays closed, imagine you're the UAE, you can't ship in food and you can't fly in food right now. You just can't. The straits are closed and your airport is closed. So you have to truck everything through Saudi Arabia and on basically a couple of roads. Are there enough refrigerated trucks to do this? Where's all the food going to come from? And so the idea that Adia, Attic, Mudabala remain net marginal buyers of S&P 500 or of U.S. Treasuries, I think that disappears very quickly if this war continues, because these guys will have domestic bills to pay. They'll have economies that will be frozen to a standstill. They'll need to pay for all the people there, and so that's one indirect consequence to think of. What if the big Middle Eastern sovereign wealth funds turn from net marginal buyers to net marginal sellers? So I would say that's the first obvious one to me, and beyond the energy consequences.
Well, China has done very little after Maduro's capture and the killing of the supreme leader of Iran, Khamenei, beyond just condemnation, rhetorical, verbal condemnation. What does that signal to you that they haven't really, at least in the public eye, taken any action against the U.S. After two of their close allies have been attacked?
I wouldn't call them allies. I would call them friends, but not
Okay.
allies. There was no allied pack. Ally. I think when you say ally, it's something like NATO, right? It's where you have a
Mm.
treaty that says, "Hey, if they attack you, I come to your defense, etc." China had none of that. And well, let me turn around the question to you. What would you expect China to have done?
Place sanctions on the on Americans. I mean, that's what the Americans would have done. Just take Russia, for example, after the Ukraine war. Sanctions on Russia, embargoes on Russia. It's kind of a double standard that none of that is being done to the U.S. right now, is what the global
So
community is saying.
So China already has, so they have the embargo on magnets and on rare earths to to the defense industry, which is proving very problematic for Lockheed, for Raytheon, and et cetera. So they have that. Um, Beyond that, what is China going to? Are they going to tell the U.S., look, we're not going to sell you tennis shoes anymore, and we're not going to sell you iPhones? It's that would be a little bit like cutting your nose to spite your face, right?
Yeah.
The I don't think that was really ever on the cards. Um,
Hmm.
the the reality is that China is actually very interested for a number of domestic reasons to improve its relationship with the United States. The the Chinese-U.S. relationship is much more important to China than the China-Venezuela relationship. The China-Venezuela relationship really doesn't matter all that much. Sure, China's made investments there, and sure they buy oil there, but the U.S.-China relationship remains the single most important one economically for China. So you're you're not going to sabotage that
Sure.
because of Venezuela. No, you're not.
So they're
Now,
prioritizing political and economic stability over global, political, I guess, ideological
yes,
alignment. Let's put it that way.
they're prioritizing the welfare of their own population over grandstanding on the international stage. Which, as a
Yeah.
European, I wish we did the same.
Okay. Fair enough. If we can get to that at the end. What happens now to what happens now to the world is my question. You mentioned earlier there's a massive geopolitical shift. Can you elaborate on what that means and what that looks like?
I think what happened. Look, it's the simple answer is we're in uncharted territory, and so I really don't know what happens to the world now. I always say that as a money manager, we're not paid to forecast; we're paid to adapt, and what we have to adapt to today is a level of uncertainty coming out of the Middle East, such as we've never seen. I think the assumption of the market is still that the U.S. is going to show overwhelming power, bomb the hell out of Iran, and Iran will come in for a negotiated settlement. And if that happens, then good. Well, obviously terrible news for Iran. But if we come to a negotiated settlement quickly, then that can be a positive on the other side. It's short-term pain, but perhaps long-term gain is one way to look at it. My fear is that it won't be that easy. Now, my belief at this stage is that what you've seen, and the Iranians have confirmed this, is that when they decapitated the regime, when they killed the whole leadership, the fallback mode was essentially for every general to do the best they can. That the chain of command was broken, and the generals were told, "Look, you have to inflict damage all across the Persian Gulf, inflict as much economic damage essentially onto the world via hurting Qatar, hurting Bahrain, hurting the UAE, and that's what these guys are doing now. The problem is when do these guys stop? I guess these guys will stop either when you have a national figure that rises to the top and says, "Okay, let's stop this war." Right now, there doesn't seem to be that coming out of Iran. Then the big problem will be, even if one does emerge, will that person have the institutional credibility to be able to be able to tell all the generals, "Okay, let's put down our weapons." Because all it takes is a few generals to say, absolutely not, I'm not putting down my weapons. I'm going to keep sending rockets across the straits. I'm going to keep sending rockets into Dubai. That then it continues. And at least it continues until these guys run out of rockets. And so the big question becomes, can we destroy enough of the Iranian rockets that they essentially run out of ammunition? And my fear is, A, they have a lot, and B, they actually have a domestic manufacturing base to continue producing them. So it's going to take a whole lot of bombing. So the bottom line is the optimistic scenario where we decapitate the regime and a new regime comes in and they make nice, i.e. the Venezuela scenario, which is what I think Trump was hoping for. I'm not sure it's going to happen. It doesn't seem to be happening, which is why I think the market that's what clearly the market is pricing in, because that's what the U.S. is saying. And the U.S. is saying, look, we're going to bomb the hell out of them. And so they'll come to the negotiating table. That's why the S&P 500 is up today. That's why oil is down today. That to me seems optimistic. But again, we're not paid to forecast, we're paid to adapt. For now, that scenario to me seems optimistic, but perhaps that's where we end up. And if we do, then great news for the whole world.
This brings me to investment implications. You wrote a book a couple of years ago in 2021 called Avoiding the Punch, Investing in Uncertain Times. And the summary of this book is to prepare for rising geostrategic strife and more global uncertainty. And I guess I know you're trying to not make predictions, but the prediction in itself of writing this book turned out to be very correct, very prescient. So tell us about some of these punches that you warned us about a couple of years ago, which ones have hit the strongest now in retrospect, and what we can do continuously to prepare for more uncertainty in 2026.
Well, thanks for playing the book. I appreciate it. The main thesis of the book, the starting point really was that yes, we were entering a period of greater geopolitical tension between China and the U.S., between Russia and the U.S. A lot of that writing was on the wall. There wasn't actually much in there about the greater Middle East. In fairness, it was mostly about these two tensions. The writing on Russia-Ukraine was sort of on the wall, and of course China and the U.S. by that point were 3 years into their trade war, and the main conclusion of the book was that if truth is the first casualty of war, bonds are usually a close second. That periods of war imply higher inflation, they imply more government spending, and they imply, perhaps most importantly, more government spending on deeply unproductive stuff, i.e. warplanes, tanks, and whatever else. And so the thesis of the book was that the old days of running a 60-40 portfolio where you had 60% in equity, 40% in bonds, if and when equities went down 20%, bonds would go up 20%. So if you had your 60-40 portfolio, you had natural diversification and everything would go well. That portfolio would no longer work. That the days of the balanced portfolio, or whatever you want to call it, that you needed a new strategy. And people were very reluctant for that strategy because the 60-40 had worked for so long and so well. And bonds had essentially been the one free lunch in the market had been diversification. And so the thesis of the book was, look, you're going to end up with a more volatile portfolio. You're going to have to accept higher volatility because the bonds aren't going to reduce your volatility anymore. And that instead of being 60 equity, 40 bonds, you should be 60 equity, 20% energy, and 20% precious metals. Or I think I just said gold, actually. So that the new portfolio was 60-20-20, and that bonds were essentially the dud asset class, and that we were going to enter a structural bear market for bonds. And in a structural bear market in which I believe we still are. The big bond bull market coincided with the end of the Cold War, a long period of unprecedented peace around the world, the big Pax Americana of the past 30 years. And I think to a large extent, this period is over. Now, granted, you could tell me, well, this this war in Iran is going to reestablish Pax Americana. It's going to reestablish the U.S. as a superpower. It's going to reestablish the might of the U.S. Navy and the might of the U.S. Air Force. And I would say maybe, and again, we're not paid to forecast and we're paid to adapt. If that's what ends up happening, then facts change, you change your mind. For now, I don't think it's going that way.
So if you think we're entering a structural bear market for bonds, that's what you said, right? Structural bear market for bonds?
I think we've been in a structural bear market for bonds for the past 5 years, for sure. It's been, look, if you own, for example, if you own JGBs, you lost 50% of your money. If you look at the past 5 years, you've, in spite of the coupons, you're still down, I think, 4 or 5% on 7-year U.S. Treasuries. If you look at German bonds, you're down 20% over the past 5 years. Now, remember, over the same period, inflation on official data is up 30%. Prices have risen 30% over those past 5 years. So in real terms, bonds have been an absolute disaster. They've been an absolute disaster. And my contention is they might not be as much of a political disaster in the next 5 years, but will they be a good inflation hedge? Absolutely not. I think if inflation accelerates from here, and you're not going to make any money, your bonds aren't going to. You're not going to beat inflation with bonds.
So then that implies rates are, the long end of the curve is going up. What does that mean for gold? So. In the last couple of years, we've actually seen gold and the long end of the yield curve move in the same direction, more or less. I mean, it's not perfect, but it's interesting because in the past, when you've had real interest rates go up, that's negative for gold. They're inversely correlated, not so much in the last couple of years. So where does this relationship go from here, do you think?
So I actually tend to believe that gold is not, a lot of people think gold is a hedge against inflation. I tend to believe that gold is a hedge against wrong monetary policy, and especially it's a hedge against 0% interest rates. That what really matters to gold isn't so much the long end of the curve as the short end of the curve. It's when short interest rates are at zero that people start to say, you know what, why am I keeping my money at the bank? I should just buy gold coins. And incidentally, if you look at the big rise in gold prices that we've witnessed in the past few years, there's been a number of drivers. The most obvious driver is that central banks that used to be net sellers of gold became net buyers of gold. And that's because the world became more geopolitically uncertain because we seized the Russian central bank reserves, which forced central banks such as Saudi, Indonesia, Thailand, China, and others to say, well, how confident I am that in a crisis I can get access to my U.S. treasuries. Maybe I'm not, so I'll just buy gold. So that's been your first big buyer. But the other big buyers of gold in the past few years have been retail investors in China and Korea and Japan. And they bought gold because the currencies were going down and because their short-term rates were essentially at zero. And so it's like, well, why am I staying in my currency? Might as well buy something else. What you haven't yet seen is either European or American or Canadian investors really buy gold to any meaningful degree. The purchases have been all out east. They've not been out west. Why? Because we actually had decent interest rates at home. So long-winded answer to your question, but if, like I believe, over the next 18 months, short rates go down and long rates go up and we get steeper yield curves, I think gold goes up on the back of this, because what will happen then is the US dollar will be going down, the euro will be going down, and it'll be going down especially against commodities. And savers in those countries will say, you know what, I'm just going to buy gold, which again, they haven't done yet.
Okay, so final question then, given your allocation that you've given so far up until now, what about international diversification? Are you still going to be prioritizing U.S. equities, or do you think there's opportunities now abroad, especially given how far Asian markets have corrected this week?
So I've not been prioritizing U.S. equities, to be very clear, and that was very painful in 23 and 24, and in 22 and 23. It was okay, and it was started to be a bit better in 24, and it was very good in 25. The U.S. equity markets underperformed last year. They're underperforming again this year. And even after the big EM pullback of the past 2-3 days. Um, I tend to believe, look, when I look at any asset class, I look at it through four prisms. Fundamentals. Now, fundamentals, the US is still an amazing story. The US was always born with pocket aces. It's it, so the fundamentals on the US look fine. Then you look at the second thing, you look at the momentum, and especially the relative momentum. And the US benefited from massive relative momentum for essentially 15 years. And that stopped really at the end of 24, towards the end of 24. And the US is now underperforming. So momentum wise, the US is no longer essentially blazing the path. Then you look, the third thing you look at after you've looked at your fundamentals and you look at your momentum, the third thing you look at is the valuations. And here on a valuation basis, the US is much more expensive than pretty much any major market in the world. And then finally, you look at the investor positioning. And here, this is where I think it's the most concern when it comes to the US is everybody and their dog is overweight the US because the belief grew that the US was the cleanest dirty shirt, because the belief grew of US exceptionalism. So everybody is essentially, look, the US is 22% of global GDP and is 70% of the world MSCI. You've never seen such an extreme divergence. So, if you look at your four pillars, fundamentals are good, momentum is underwhelming, valuations are a problem, investor positioning is a problem. So I don't think the US equity market is the play here. I compare that to China, where the fundamentals today are very, very attractive. China's got the cheapest cost of capital, the cheapest cost of labor, the cheapest cost of electricity. Fundamentals are good. Momentum is good. Valuation is attractive, and investor positioning, no one is there. And there's lots of other markets where you're striking, essentially, you're ticking all four boxes that I don't feel a need to be in the US.
Okay, perfect. Well, thank you very much for your update, Louis. We'll follow up again soon. Where can we follow your work for now?
The easiest is probably to go to our website, gavekal.com, where you can find all the information. I am on Twitter, but I don't post a lot. I'll post the occasional piece on there, and I'll also make the occasional joke for people who have bad sense of humors, like I do. So you can follow me, and my handle is Gav_Vincent, or Gav.Vincent. So you can look for me there.
Okay, well, we'll put the link down there below. And before I let you go, I just want to get your take. You said, as a European, you wish the Europeans did the same. What do you think Europe should be doing? And I know this is a loaded question, and I know this is the last part before we go, but just in a minute or less,
how much time do you have?
What's wrong with Europe?
Well, let's start off with the most obvious thing, which is that economic activity, once again, is energy transformed. So we should start off by having a coherent energy policy, one that doesn't sabotage our entire economic activity. I think in Europe, I take my own country of France, we used to have 90% of our electricity produced through nuclear. And Macron has essentially spent the past 15 years trying to dismantle our nuclear energy. Now, he switched in the past 2 years, realizing his mistake. But the cost of that has been an absolute disaster. And as bad as France's energy policy has been, Germany's has been worse. So if you take the two biggest economies in the zone and you saddle them with suicidal energy policies, you're not going to get great results.
Let's follow up more next time. Thank you very much, Louis. We'll put the links down below, so make sure to follow Gavekal there. And thanks for watching. Don't forget to like and subscribe. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. And when you use my code, new traders can get $10 deposited to your account when you trade $10. Link down below or scan the QR code here.